everybody. Mike Newmeyer again. Great to be with you. And you know who I am by now, I guess. I'm a financial advisor. We put on a show every week. We're located in Owings Mills. My telephone number is 410 902 0464. And I'm more than happy to answer questions. As you listen more to the show, and if you have listened in the past, you know that part of my mission is education. In fact, I put on maybe 100 seminars during my career to help people get ready for retirement, understand all of the issues related to it, and so forth. So, again, we go through the seminar on air. And if you want to look at more of what we've done, you can go on our website, Game Plan for Retirement. You can download a whole series of episodes from the show. You can get more information. And of course, again, you can call me at 410 902 0464. And I'd love to talk to you. I've never charged for my time on the telephone or in person. And if you want to come and see us, we'd love to have you make an appointment. There's no charge for any of those things. And I can do an informal evaluation of your situation, and I can help you put a plan together, which I help people do all the time. Okay. So I've been doing this for a long time. Got a lot of experience, over 25 years, and I've worked with a lot of people during that time. So, you know, I learned from them. They learned from me. We've had a great ability to work together. And today I still have over 100 active clients. I'm always ready to help somebody else. So that's just to begin the show. Now, today we're going to talk about investments. I'm going to tell you about all kinds of investments. I'm going to tell you the reason people use them, the reason people don't use them, and you can figure out if you like, whether they fit your needs and so forth and so on. And this is something that usually people want to talk with their spouses about and their families about and so forth. Unless nobody else is interested, and of course that does happen. Okay, I've had husbands and I've had wives tell me he or she is the one that takes care of the money. I don't really get involved. I've had that too. So it's always an individual situation or situation that the couples decide on. Okay, so I'm going to talk about considerations before you invest. What do you have to think about? I'm going to talk about categories of investment. I'm going to talk about cash accounts, which is seemingly more important or more interesting or more popular today than they were, some time ago, primarily because of interest rates. Bonds, stocks, mutual funds. Almost everybody listening has had mutual funds either in a plan at work or they've just gotten into mutual funds on their own. Unit investment trusts, not too popular these days, but they're there. Individually managed accounts, what does that mean? Tax deferred annuities, which is our bailiwick. That's our wheelhouse, and we will help you with those. So we'll talk about those. And then what kind of risk there is in all of these things, and investment risk management strategies. So what does that mean? Well, we'll get into all of those things. So that's a list of the kind of thing we're going to try to cover today. And then, of course, towards the end, we'll give you an idea of what we're going to do next week, give you a little review of what we've done today, and help you, So we're going to start it with investment considerations. And, you think about, why are you investing? Are you looking for growth on your investment principle? Nobody has ever said to me they aren't looking for growth. So let's assume that most people have that in mind when they invest. Do you need your investments to provide you with current income? And some of these investments we talk about, we're not going to use for current income, but we expect to use them for income, in the future. That's why we think of them as retirement investments. Do you want growth and income? Do you want to take income now and still have those investments grow? And again, I've never had anybody tell me that they don't want growth and income, even if they're not going to start the income now. Okay? So that's typically the way it is. Now, there's a thing called time horizon. What does that mean? That means, when do you want to start income, or when will you need to start income? Even though you may not start it when you think you're going to, what is the earliest date that you believe you're going to have income, because that's what we have to shoot for. We can't think about delaying it. It's like somebody that has a worsening health condition. You don't wait, until it's too late. You have to start it, earlier on. Okay, so we think about when is it supposed to happen, and then we want to think about our investments. When are they going to be mature? When can they produce income? When can they produce enough income that is desirable to us, and so forth and so on. So that's time horizon. A longer time horizon may allow you to take more risks. Yes, that's true. So if you're younger, you can afford to take risk in things like, well, in the market, so mutual funds or stocks or bonds or whatever, because you're not going to need that, to use that, for a very long time. So people in their 30s, as an example, ought to be taking more risk. They ought to be taking more risk. And so that's one thing you want to think about. And as you get older, shorter time horizon creates a need for some, but not necessarily all, of your retirement investment to produce income at that point. Okay? And even if you're not going to use all of those investments for income at that time horizon, or that designated time horizon, you still want them to be able to produce income at that time, because that gives you options. The last thing you want to do is be going down a one-lane street. You do not want to be in a position where you have no options. You always want to have options. So that's why I say your time horizon should be the earliest time you might need that income, all of it, even if you don't use it all, and let some continue to grow. Okay, so that's the way that works. Don't count on a good market. We've been to a lot of markets, haven't we? Good, bad, and so forth and so on. And the younger you are, the more you can take risk. But as you get older, you don't want to be taking a lot of risks. So we tell people, and we believe, that retirement money, once you're, say, 50 years old, should not be in the market. And if it is, you need to reduce your risk. That means that the things you're putting money into in the market have got to be more conservative. They have to be low risk kinds of things. Okay, so that's a kind of a place to start your thinking. Once you have a good financial investment plan in place, you may need to discipline to stick to your plan. And you also have to be nimble. You have to be ready to make changes with some good advice whenever when it looks like you need to make changes. Then it should be something you're reviewing with your financial advisor. You don't want to be if you didn't need one to begin with, you wouldn't have gotten a financial advisor. So when things start to look more risky, you need the financial advisor almost more than you did them in the beginning. So you don't make big moves without some guidance. And so now current investments, of course, could be anything from savings in a bank, which is finally paying a little interest. Could be bonds at different times. It could be stock and so forth. And then the tax situation. Well, if you're in a 401k or the like, the tax is deferred, isn't it? Until you start taking income. If you're in a Roth IRA, you've paid the taxes already on that money. So now it's going to sit there. It has to be over 59 and a half, and it's got to be over 5 years. But, most people would have that satisfied by the time they get to retirement. But you can always do it, later, but it's got to be 5 years, and you have to go past 59 and a half in order to actually take money out and have it be completely tax-free. So investment categories. Let's talk about categories. Loaning money versus owning investments. So loaning money means, for instance, bonds. Purchasing and owning an asset is just the opposite. It's owning an investment. So what is an asset? Well, it could be a lot of different things, couldn't it? It could certainly be property. It could certainly be stocks and bonds. It could be lots of different things. And CDs, owning the CDs, those are all investments. Now, what about loaning? Well, loaning, of course, basically you're talking bonds. And so in those cases, you're going to buy the bonds when they're cheap, and you're going to sell them when they're high or at maturity, which point you'll get all your money back, and you're going to look at what it earns, to maturity in terms of the dividends, in terms of the coupons, in terms of however it's paying interest and so forth. If you sell it before that, you're going to pay capital gains, and unless it's reinvested in another, if it's inside of a 401k or in an IRA, then of course it can be reinvested in another asset. But you're going to buy low and sell high. If you're interested in investing in them, that's a typical rule. So they run in inverse. In other words, the lower the price is, the higher the dividend is. Okay, the higher the return is. So that we'll go into that if you want an explanation and are interested in learning those things. This is the kind of thing I've taught in my seminar, still do, and I'm more than happy to spend time. It's a little confusing to people when they first hear that. So you can ask me more about that if you're interested. And then cash reserves. Let's talk about cash reserves. I can give you a rule of thumb, which a lot of people don't follow, okay? But cash reserves, in my opinion, ought to be equal to the years at your age. In other words, if you're 30 years old and you got $30,000 in cash return, in cash investments, or in cash reserves, you're not going to be facing problems you can't take care of. That's an opinion. Very conservative, very safe. When you're 50 and you have 50,000 in cash reserves, where are your cash reserves? Could be CDs, but more likely it's in things like savings accounts and so forth, because the money has to be available, immediately available. So the older you get, and it's not unusual for me to look at people in their 70s that have well over $100,000 in checking accounts and savings accounts. You might say, well, they're not making any money. It's just a little different situation. What they're buying is peace of mind, and they want that peace of mind. That's more important to them than the growth on that money at that time. They're more interested in income and cash reserves. So that's their focus by the time they get to be retirement, and it should be their focus. They should be becoming safer and safer the older they are, okay? And we won't take all of somebody's money and invest it in other things. We want them to have reserves. That's a prudent approach. And for an advisor, that's necessary to help people understand that and guide them in that manner. Okay, so cash reserves. And then cash accounts, what does that amount to? Well, you know most of them. Savings accounts, CDs. Some of these things weren't doing any good for us for a long time. The income rates were the return was very low. And now they're better. No, they're going to come down again. Rates will come down again. So locking some things in, into CDs and so forth, not a bad time. But those are reserves, and those are cash accounts, I should say. And money market accounts, same difference. I've seen money market accounts last few years that were nearly equal to 1 year CDs. But the main thing is that's money markets, okay, are another form of reserves. They're part of the reserves that you should have. Money market mutual funds, I don't really like. There's risk in mutual funds, and for it to be a reserve, it's questionable. Even in a stock account, when you have money in cash, that's one thing. To have it in money market mutual funds, you have risk. Why bother to do that? Either put it into stocks and mutual funds or something of that nature. Why put it in a money market mutual fund where the return is very low anyway? If you think it's cash, it's not. Okay, cash is a cash balance that's available instantly. So you keep those things in mind when you make those choices. And then, of course, bonds, I gave you a little bit of information on those. You got different bonds, don't you? So you got government bonds, typically T-bills. The 10-year bond is the most popular. And that's what people will say in bad times. They move money into T-bills. And that's one way of dealing with questionable times. And the bonds can be looked at in various ways. different kinds of bonds. Okay, number one bonds are government bonds. T-bill's a 10-year bond, most popular one. And then you've got shorter term government bonds. Federal bonds are 2 years, 5 years, and so forth. And then you've got the long end of the yield curve, which is going out to 20-year bonds. And it's interesting because sometimes you have an inverse relationship in the yields on these bonds. Sometimes you'd think that a longer bond, 20-year bond, 10, 15-year, whatever, would pay more than a short-term bond, but it doesn't always work that way. Sometimes at the long end of the yield curve, instead of say if you had 4% or 5% on a 10-year bond, you might only have 2% on a 20-year bond. It depends on the bond market. So there's no set way for those things to operate. It depends on the bond market. Remember, it's buy sell all the time. If the traders are moving back and forth all the time, so it's variable at the very least. Okay, and so those are things to think about. And then there's corporate bonds, and you've got AAA corporate bonds with the biggest companies in America, the strongest companies in America, obviously. You've got municipal bonds, which are based on your community, your city, your county, your state, and so forth. They're borrowing money from you. Bonds are a way of borrowing money and then repaying the money with interest. But the interest may vary. Okay, not always. It could be guaranteed, a little different, but basically the interest can vary as the bonds are bought and sold and so forth. So, and then besides that, you have what's called junk bonds. What are junk bonds? Less than investment grade is what junk bonds are. Okay, subprime is another word that is used sometimes. So those are, you need to be really understand them. To be, there's no safety in the market at all, but subprime bonds, less than investment quality, junk bonds are traded heavily. Now these are very knowledgeable investors that are buying, selling all the time, and they pay a bigger yield. There's a reason they're attractive. So if a 10-year treasury is paying 4%, then a junk bond might be paying 8% or 7% or 6%. That's the reason that it attracts the knowledgeable investors. Some knowledgeable investors wouldn't touch them. Okay, this is a world of its own. Okay, so that's the way that all works. And then what about the ratings? How is that determined? Well, it's based on the credit quality of the issuer, and so an investor will look at the length of the term on the bond, but also the quality of the investor and quality of the issuer. So if you're dealing with an issuer, a company that has any kind of questionable financials, and they're issuing a bond, it could end up as a junk bond, based on the quality of their credit. So those are all things to consider, and most people aren't going to get into the weeds on these things, more for professional investors. Credit ratings, there's different companies that do credit ratings. Moody's, Standard & Poor's, Fitch, those are all companies that assign ratings to different investments. And so having a little bit of knowledge of that, worthwhile. Morningstar ratings on mutual funds, good to know. Look them up. You can go online and find that information very quickly. So if you get a 5-star rating on a mutual fund, it is considered to be a very high quality mutual fund. And that's a Morningstar rating. They're not the only ones that rate, but they're the ones that most people quote. And so that's some of those things. And let me skip some of these other things. There's more about bonds. A lot of information on bonds that we talk about in the seminars. And then owning investments. All types of equity investments share the following characteristics. What is equity? Equity is owning. So equity is basically, when we talk about equities, we're talking about the stock market. And then it is based solely on supply and demand. So if you have a stock that has a market cap, such that there are 60 million shares out there, make believe, and their competitors have 100 million shares. Well, their shares may be considered of more value because there's less supply. It's not as easy to buy them. And the more that comes out, the lower the price will go because there's greater supply. It's seldom that demand and supply equal each other. So at least in the beginning, I noticed a stock that just came out that was very popular, came out at $10. At the end of the day, it was up to $80. That's not typical. That's not typical. We'll have to watch how quickly it comes down. Maybe it most probably will. But obviously those people that got in the beginning, let's say they bought it and did day trading and sold it by the end of the day. Well, they made some money. But that's always supply and demand. If there's a limited amount issued, there's a rush to the door to get it. It's just like when a department store puts on a big sale. There's people waiting outside the door to get inside. They know that the sale is going to be over at the end of the day, and there's not going to be more inventory added that day. If they want certain things, they're going to get in there while the supply is there. So it's the same thing. If you know there's a limited amount in the issue of a new equity, a new stock, and you really want it, obviously you're going to do everything you can to get it. So that's demand and supply. All right, so those are other things that count, of course, are things like dividends. For dividend buyers, dividend investors, they're going to study what's the biggest dividend and what's the rating on that particular equity. If it's highly rated, highly known, large company and so forth, great track record, and you can look at what their track record has been over the last 5 years, let's say, yes, and it pays 5% or 6% or 7%, which is not that unusual, and you're a dividend, you're depending on dividends for income, well, then you're going to get in there and do some of that probably. Capital appreciation, this is for growth. So a growth stock is anticipated to grow at a certain rate. And that's for long-term investment. What's long-term? It depends on the individual and their event horizon. When are they shooting to use the money? Okay, during that time, there may be a lot of volatility. You have to anticipate that. We've seen some stocks that have tremendous volatility in the last few years, but they're still on a track to move forward and to gain value. So there's a lot of things to think about when you're going into the market. And then inflation hedge. So you've got stock or investments. Now, what's the most common investment hedge in investments that you can think of? Well, one of them is real estate, because real estate typically continues to appreciate. Look at when I bought my first house versus what it costs today. When my parents bought their first house, they bought it for $4,000 in the 30s. Well, this is a long time ago. That same house, what would it be worth today? And on and on. I have a sister that bought a house in Venice, California in the 60s for $33,000. Just sold it last year for $900,000. That's appreciation. So real estate is a great investment for appreciation. Another one that is a hedge that works against inflation or with inflation very well is gold. So precious metals oftentimes can mimic the appreciation that in real estate, so that basically I saw gold was trading for well over $3,000 an ounce last week, and it's up over 31 or 2 today. So, those are hedges against inflation. There are some stocks in the market that work the same way. They're really funds, okay, that you can buy. Okay, all right. So that's a little bit more about some of the things you can do on inflation. What about stocks in general? The problem with stocks, other than the fact that they can make good long-term investments, you always have the volatility to concern yourself with. Now, you can have stocks that go very high and then very low. Well, if you need the money here and you bought it here, you're in for some unhappy times. So the market never makes up typically for what it's lost if you're taking money out. So if you bought it here and it's going like this and you're taking money out on a regular basis, you're never going to make up that amount of money when it comes back up. You see how that works? It just isn't going to be made up because you're taking money out on a regular basis. Okay. So those are some things to think about. I hope that today is helping you. I hope today is giving you some information, because there's so much to cover. There's so much to cover. I mean, I basically have covered about half the information. Next week, we're going to talk about income. We'll talk about more about the investments, but then we'll talk about how do you get the income out of the investments? What's the best way, the safest way, the riskiest way, and so forth and so on. What can you count on? That's what you need. But remember what I said in the very beginning, that in when we started this series, it was in income and expenses are the two most important financial issues that you have to deal with in retirement. You've got to know you're going to have the income because your expenses are going to go up for sure. They're not going to go down. Now you say, well, when I retire, they may go down when you retire, but then they'll start back up because of medical expenses and various other considerations. We're going to have to leave it there. We're just about out of time. Remember, you can call me. I'm more than happy to help you, work with you, talk to you. Give me a call. Mike Newmeyer, 410-902-0464. Look for you next week. Thank you.